There's a really strange signal flashing in the economy right now, a warning light we actually haven't seen in over 30 years. And it suggests that the financial system as we know it might be starting to fracture, and that a major economic reset could be just around the corner. So what is this signal? And what does it mean for us? Let's get into it. So let me ask you this. Does this feel familiar? You turn on the news, you see headlines about the stock market hitting all-time highs, but then you look at your own bank account, your own budget, and things just feel tight, tighter than ever even. Well, if that sounds like you are definitely not alone. For the first time in more than 3 decades, these two feelings are splitting apart dramatically. Confidence in the stock market, it's soaring. It's even higher than it was during the dot-com bubble. But at the exact same time, how we feel about our own personal finances has just cratered. It's down to a crisis-level low, right on par with the absolute depths of the 2008 crash.
Now, this isn't just some random statistical fluke. The analysis we're digging into today argues it's a huge red flag, a symptom of a deep structural problem in our economy, one that points towards an inevitable and pretty significant reset.
Okay, so where does this break even begin? Well, the first piece of the puzzle is this massive, growing gap between what we earn and what things like stocks and houses are actually worth. For decades, the economy had this, predictable rhythm to it. Real personal income, that's what you earn after you account for inflation, it grew at this nice, steady pace. And that stability, it meant people could actually plan for the future with some level of confidence. But after the 2008 financial crisis, that rhythm just broke. For more than a decade now, the kind of income growth that people expected, the kind that history told them they should get, just hasn't happened. It feels like the goalposts just keep moving further and further away. Let's actually put some numbers on this. Since 2010, real personal income has got up by about 50%, which, sounds okay on its own, right? But wait, compare it to this. In that same period, the S&P 500, even when you adjust for inflation, has exploded by nearly 300%. And this right here is the whole story. While our paychecks have been a letdown, financial assets have absolutely shattered every expectation. This really illustrates the core problem perfectly. A gap this wide between the real economy, wages and jobs, and the financial economy of assets is just fundamentally not sustainable. As the source material puts it, they can only diverge for so long. This is the setup for what they call the Great Reset. So the big question is, where is all this crazy asset growth coming from? And more importantly, who is actually benefiting from it? Check out this contrast. It's pretty wild. While the average person's ability to save money has just plummeted over the last 40 years or so, corporate profits have been soaring to record highs. They are almost perfect mirror images of each other. The mechanics of how this works are actually pretty simple. Those record-breaking profits, they get handed out to shareholders, and shareholders tend to save and invest that money, so they pour it right back into financial assets. This massive flood of capital is what's driving up the price of everything, stocks, real estate, you name it, to these insane highs. And here's where it really hits home. Literally. For most of the 20th century, a typical house cost about 4 times the yearly household income. Today, that ratio has jumped all the way to 7. Housing is nearly twice as expensive for us relative to our income as it was for our parents or grandparents. And this economic reality has a huge psychological impact. Think about this. Back in the year 2000, 3/4 of Americans believed they could improve their standard of living. Today, that number has just collapsed to only 1/4. That is a staggering loss of optimism in a pretty short amount of time. Now, this whole combination, soaring assets for a few and stagnating opportunity for many, it's not new. In fact, if we look back through history, there's a chillingly similar parallel. And this, right here, is the key historical connection. Wealth inequality today, if you measure it by the share of wealth owned by the top tiny fraction of a percent, has reached a level we have not seen since just before the Great Depression. And get this, back in 1929, the absolute peak in wealth inequality happened at the exact same time as the peak of the roaring stock market. And we all know what came next, the infamous crash, the Great Depression, and then a long, multi-decade reversal of that inequality. The parallels are just spooky. But a massive reversal like that, it doesn't just happen on its own. It needed a catalyst, some kind of trigger. So what was it? What was the thing that kicked off the last Great Reset?
So, what was that trigger? Well, the argument we're looking at says it all comes down to a single policy tool that has swung back and forth wildly over the past century.
Take a look at the wild journey of U.S. corporate tax rates. They went from basically zero in the 1910s, then they were pushed way higher during the Great Depression, then they were slashed in the 1980s to try and stimulate a struggling economy, and here we are today, right back near historic lows.
And this brings us to the core of the theory, that the sharp rise in corporate taxes was a key trigger for the 1930s market crash. And while it was incredibly painful economically, this policy squeezed corporate profits, it dragged down those inflated asset prices, and ultimately, it was the mechanism that reversed the massive trend of wealth inequality.
And this brings us completely full circle. The conditions of the 1920s, low corporate taxes, peak wealth inequality, are precisely the same conditions we find ourselves in today. The stage seems to be set for a very similar story to play out.
And that leads to a pretty powerful prediction, that the next Great Reset, the event that finally starts to close this huge gap between asset prices and incomes, will begin when that pendulum of corporate tax policy finally swings back in the other direction.
So, if this analysis is correct, a painful, system-altering reset might just be inevitable. Yeah, it would likely mean falling asset prices and a lot of economic turmoil in the short term, but it could also be the very thing that leads to a long-term rebalancing of the scales. The question then is no longer if a reset is coming, but when.